Hey guys, welcome to Elite Acquisitions and Investment Banking. And I'm here with Bill Wiersema and Ansi Monsión. This is episode 11. And like I said, Bill is back and he has a presentation to share with you guys. So, Bill, thank you for being on this podcast.
Yeah, thanks so much, Vale, for that introduction. And I just wanted to mention that I'm honored to be presenting for a second time to this great group. There are a lot of very talented people that are part of it, and I'm very happy to be associated with them. And my presentation this evening, as you can see from the slide, is going to be talking about financial due diligence and quality of earnings reports. And the idea tonight is to allow for an interactive exchange rather than just a note-taking exercise. And so to that end, I'd like to feel comfortable asking questions to make this mutually beneficial. So I think we're already ready for the next slide. Oh, sorry. Can you hear me?
Yeah, we have you loud and clear.
Okay, I got a chat that maybe you couldn't. All right, so if we're good. All right, I hope everyone can hear me. There was a chat that came through, but you're confirming you can hear me?
Yes.
Okay. All right, very good. So let's move on to the next slide. It's a little bit about myself on the next one. So there you go. Yeah, Bill Wiersema. I'm a principal with Miller Cooper & Company. We're a CPA firm, and I specialize in financial due diligence and pride myself on saving my clients from 6 to 8 figures per deal. I'm really super excited to be here because in the end, due diligence is a very critical topic to all of you because you're dealing in acquisitions. It's a topic you need to know about. And then the next slide is a little bit about the firm itself. If you could, Vale.
Yeah, it looks like there's a little delay. Yeah.
There it is. The firm, a 400-person firm, accounting consulting firm headquartered in Chicago. We've been around for 100 years, celebrated our 100th anniversary a year ago last June, and I am very proud to say that I service a client that's been with us the entire time. So that's quite a legacy, and I'm very happy to be part of the firm. So let's move to the next one. All right, let's start with an overview. What are we talking about here? And the purpose, I should say, of my presentation is to give you an overview of what the due diligence process is. It's not to teach you how to do it. That's something that would take years and years of training, but rather how to benefit from the materials and the service of quality of earnings and financial due diligence. And just to give you enough of an understanding so that you can appreciate the importance of the engagements and the materials that it provides. So here's the definition. The due diligence process enables buyers to assess whether the transaction will yield the benefits that they hope for. And I kind of liken this to a home inspection. If you bought a house, you will look at the roof and the foundation. Of course, the seller says everything's fine, but you want to bring in your expert just to make sure that there are any leaks and the foundation's sound and it's not going to sink into the earth. That's exactly what I do, but on a larger scale. I'm trying to evaluate the financials of the company, and I deal with numbers. And numbers, whether you like them or not, are integral to transactions because they impact value, they impact how much financing you can get, they impact the benefits that you are going to get from the transaction. But financial is only one part of the diligence universe. There's also operational, and that's something that you as the buyer would generally engage in. And then there's also the legal side, which your counsel would do. But when I talk about financial, the main metric here is EBITDA. And when I give this presentation to MBA classes, I have the whole class recite this with me. It's earnings before interest, income taxes, depreciation, and amortization. That's a key metric. And the reason it's a key metric is because if it goes up, value goes up. So what do you think happens then? Every seller has a little bit of a motivation to use puffery and make the number better. And that's what we're going to hear about tonight. That's what due diligence is about, is verifying that the EBITDA you're being presented is the correct one. So let's go to the next slide. Everyone, I think, knows who Marcus Lemonis is. He's the guy on that hit business reality TV show, The Profit. And, we all know his motto with people, process, and product. So My first quiz is, which one is he dealing with? And definitely it's going to be operational. This is a wonderful show if you're dealing in Main Street businesses, and sometimes even extends beyond that, in what to look for as an operator, as someone who's considering buying a business. So let's flip to the next slide. So if I were to do a reality show, what would I call it? And the photo gives you a little hint here. What do you think? Cooking the books, right? So whether we want it poached, hard-boiled, sunny side up, the question is, are you ready for a culinary treat? Because that's going to be the rest of the presentation. So let's move to the next slide. So what do I do in diligence? The first step, whoops, I think I lost something here. The first step is to identify red flags. And what do I mean by red flags? Well, what I do is I will line up, and Nancy and Valentina both seen me do this. I will line up current year to date, annualized, I will against prior year, and then also industry, and do what's called a 2-finger flyby, actually 3 fingers, to identify what's out of whack. What might be wrong here. Are profits unusually high? Are assets bloated? Are liabilities too low? What does this tell me about the company, its history, in comparison to industry? Does anything look unreasonable? And once I've done that, I would, during that process, I should say, I'd consider myself kind of to be unraveling a mystery. It's kind of like being a detective or an episode of Forensic Files. And I will, assuming that we have time, be able to present a quick case study later to show how that works. But basically, this is the first step. And one thing to be aware of when you're looking at SIMs and all the offering memorandums that circulate is that sometimes those numbers don't actually come from the company's underlying records. I've actually seen information memorandums without dates on them. I've seen them where it says historical results are estimated. You have to be very careful of what you're actually looking at. So let's see the next slide. And this next slide gets us to add backs. And there's actually, this is one you have to click again, Valentina, to see what's going on. As I mentioned, there's puffery, there's a lot of things that go on. And sometimes with alchemy, you can turn losses into income. And as we had here, we had 5 million adjusted EBITDA, but that's only after $10 million in add backs. So that's a bit extreme, but it's a true story. And none of the stories that I'm going to give you tonight are made up. And although they may seem strange, they're not fiction. So let's go to the next slide with add backs. And so today, the big one in add backs is COVID. So EBITDA now becomes EBITDAC with the C on the end for coronavirus. And as we know, COVID can cause a lot of problems, lost orders, breaks in the supply chain, safety reconfiguration, closures, remote relocation, layoffs. But on the plus side, we may have our paycheck protection loan forgiven. But to me, the legitimacy depends on having specific supporting documentation. You can't just assume that the proceeds from a PPP loan exactly equal the damage from COVID, because I've seen a number of my clients actually experience the opposite, where they actually went on to have record years after having a terrible March and April of 2020. So you can't equate one to the other. The key is to be sure that you have support for that add back. And then normalization, you always have to beware of that word coming up, because sometimes I've seen sell-side quality of earnings reports where what normalization really means is we went back 3 years and we picked the best year and called it normal. So what is normal is very subjective, and you have to be careful and skeptical when you see normalizing adjustments. And I'll give you an example. Of course, I'm with an accounting firm. We just ended our busy season. Of course, people were putting in very heavy weeks, a lot of time, a lot of effort. Whoop. And what happened then, now that that's over with, is we expect that there were going to be some staff downtime. I mean, that's just kind of natural in the industry. But what if I were selling my business to you and I were to tell you that all of that downtime is an add back, that this is abnormal, this inefficiency shouldn't be counted against me? You'd say I was crazy, right? Well, look at your next software deal and be very careful, because what I've seen more than once is IT companies sending consultants out into the field to do projects, and then when they're idle in the office, giving them proprietary software projects to work on, and their time gets capitalized, it's called, actually parked into an asset on the balance sheet called software development, and doesn't hit the income statement or EBITDA. So, and then when you amortize that asset, it's the A in EBITDA. It's amortization. It's an add back. So all of a sudden, magically, you've converted what would otherwise be payroll expense into amortization, and you're not incurring the type of expense that going forward and on an actual cash basis you're incurring. So you have to be very careful of that. And then the next item, one of my favorites, hopeful projections sometimes. I've actually seen a number of situations where there's something new that's been implemented and people want to backdate that, even though the savings from it haven't even been fully realized yet. And what it amounts to, in my opinion, is an idealized version of history. It really doesn't relate to what you're buying or what the bank is going to lend on. It's that type of thing that has to become subject of an earnout, which we can delve into in as much detail as we'd like. Earnouts have become more and more common actually lately. And then another thing, before going on to the next slide, you just have to be aware of a number of things too when you're looking at add backs. The first is, was this add back, so-called, actually deducted from EBITDA to begin with? So I've seen situations where owners are taking distributions through retained earnings, and those are claimed as add backs to EBITDA, or loan payments. Those are not, they're not add backs because you never deducted them on your income statement to begin with. So you have to be very aware of that. And then the second thing is, really, is the underlying data reliable? I've gone into situations where, again, there might be a sell-side quality of earnings report where data has been extrapolated, called normal, this and that, used in various ways, but no one's questioned whether the underlying data, which is often unaudited, is even reliable. So it's really a house of cards to try to build add backs based on that type of data. So let's move to the next slide. So you have to keep in mind here, when you proceed to the next steps, that there's no generic approach. It's really all based on the specifics of the deal that's being worked on. It's based on that initial step, that we just went through, just looking for the red flags. And that way I can collaboratively assess risks with my client, the buyer. And so the procedure at the top, again, no cookie cutter here. We have to determine procedures based on what we see, and then kicking off with a target. It's always critical to establish a connection early. Sometimes sellers who haven't been through this before are very nervous, and I have to reassure them that I'm not the IRS. I'm not there to degrade what they're doing, but rather collaboratively solve problems that come up, if they come up. So you got to get people comfortable and then perform field work. It's going to be a week or two out generally, which gives me time to bring in the right person to assist me with the quality of earnings, someone who has usually a specific background in the industry that's being looked at. And then communicating findings is something that I pride myself on. Once I have had that period of time to prepare for that meeting with the target and go through that meeting, just about ready to talk to you about any significant findings. So it would happen after that meeting that I'd be able to put that together. And I can tell you honestly that 98% of the time there are findings, whether the company has records coming out of a shoebox or it's been audited by a Big Four firm. 98% of the time there will be significant findings. So that's something that I would communicate at the end of day one. It's not something you would wait for a report to be able to find out about, because that is way too late. And then by the end of that week, give you an adjusted EBITDA schedule, a preliminary schedule. And then assist with resolution. That's very important, because again, the idea isn't, an OMG moment, what's going on, but rather find a way to move the deal forward. And I have been able to do that. It's a matter of identifying the problems, making sure that you're aware of them, and then moving the deal forward. And whether that takes more negotiation or whether, the findings are something you want in your back pocket when you're negotiating something else later, all of that, all those considerations come into play. You, of course, are in the driver's seat with how we deal with the findings. And then the final item, the report itself, that's really an anticlimax. Now, as a 400-person firm, obviously I have a QC department and processing that reports have to go through. So it's not going to be instantaneous to get a draft report. But as I said, by the time you get it, you'll know the issues. You'll even have resolved the issues. So that report is really an anticlimax. It's going to be more for the bank or for your investors. So next slide, please. You can have a look. So what are we talking about here? Some risky areas. So I want to give you a couple examples here. Excessive or unsupported add backs. I think we've talked about that one ad nauseum. So that's the first one. Second one, inadequate records. So this is an example, again, a real life example. Brilliant engineer owned a small business, and he was actually one of the original domains on the internet, believe it or not. That's how far back he went and how technologically oriented he was. Way ahead of his time. And designed his own accounting system. It had CRM, it had ERP, everything he could ever dream of. And that system was something that he was going to sell to other companies potentially. That was even in mind because that's how good it was. Well, one little known problem going on, though, was he had engaged an outside CPA, a person who came in every month for the past 30 years, to download the data off of his system into QuickBooks and produce monthly financial statements, which became part of the tax filings at the end of the year. No one ever looked at these statements. He didn't need to, the owner didn't look at them. That wasn't information that was useful to him, but it was something that in order to comply with, the government requirement of filing taxes and keeping records, he brought in the CPA to do. Well, the problem was when I looked a little harder at what was going on, that data that was downloaded was incomplete. This accountant had to plug balances, like he had to plug inventory, plug receivables. Any major account, he had to just plug the balance, force it, because the system that the owner had created had not been designed with accounting in mind. There was not a complete trail of additions, deletions, all the transactions that make up an account balance. So in the end, when I tried to do a due diligence engagement on these records, I found that the gross profit margin month to month was like this. It was just all up and down across the board. And in the end, had to tell my client I couldn't come up with a trailing 12 EBITDA. And that was something that they really needed to have, really wanted to have. It's just that the records, even though this system appeared to be the most wonderful thing imaginable, it didn't handle accounting properly, and it wasn't designed to do it. The owner didn't care about accounting, and in the end, unfortunately, his deal couldn't move forward that way. And then also related party transactions. We need to touch on these a bit because there the owner is both buyer and seller. And the obvious ones are compensation or rental of personally owned real estate. But there are other things that are not so obvious, like sales to affiliated companies or purchases from affiliated companies that aren't at arm's length. And remember, arm's length means that there's different parties on either side of the transaction. Here there aren't. I've even seen on a recent deal where there have been sales within the company from division to division that somehow the receivable didn't get eliminated, which is crazy. But I have seen that. In every case, what happens is EBITDA gets overstated and the buyer potentially overpays for the business. So you have to really be careful anything that involves related parties. And then inventory. That's one of my favorites. I actually just did a white paper on the problem of inventory and how to handle it because so many companies have trouble grappling with it. And the issue, though, in due diligence is that if you're a business that's doing poorly, basically the classic way of generating profits when you're losing money is to raise inventory levels. And, you can do that by capitalizing more overhead or just writing old stuff that you've written off back on, or even just, play with quantities. And I've seen that particularly when there isn't a perpetual record in place. So due diligence really needs to make it a focal point. And if you want to understand why that's the case, you really don't need to do much more than go back to, thinking about how does inventory roll forward? What's an equation for inventory? It's as easy as, you start with a beginning balance, right? You add purchases, you subtract what you sold, you come up with an ending balance. But if you rearrange that equation, algebraically, what you find is cost of goods sold, which is the only element that impacts EBITDA, equals beginning inventory plus purchases minus ending inventory. So the bigger the ending inventory, the lower your cost of goods sold gets, and guess what? Your EBITDA goes up. So again, it's a technique of choice. There's many, many ways to overstate inventory. So you have to be very careful, in companies that involve inventory that isn't going on. And then we talked about inappropriate capitalization earlier with the software companies, liabilities and reserves. You have to be careful because sometimes the payables are in the drawer, awaiting approval. They haven't been entered to the books yet. So what are you going to do? They're not in there. They're supposed to be. They should be. By all accounts, matching would say they have to be. They're not. And then finally, revenue recognition. Really a lot of options here. You can do it at order. You can do it at collection. It's completed. At shipment. And most commonly, you do it at delivery, but it might be only after accepted or when consumed. So a lot of different options. The problem is picking the right one. And let's talk about an example of that, and that's on the next slide, if we could. So the next slide addresses customer deposits. So here's the scenario. You know how advance payments work, and I actually saw this. I see this very often, many different contexts, but one that comes to mind for me is a prospective client I had. They were searchers. They were brothers. And they said, hey, we might want you to do our work. Could you propose on our work? And I said, well, normally as part of proposing on an engagement, I offer a free of charge review of your materials. That's going to be your LOI, the financials of the company. In order to be able to identify red flags and then put together suggest a program that addresses those red flags and collaboratively determine the right mix of procedures, that balances budgets with, the budget that you want to spend with the benefit. So I signed my NDA, I got the materials, and what I noticed was, this was a company, it was a SaaS company, it charged a year in advance for many of its services, but it was doing cash basis. So, wow, I guess that's okay, you're on a cash basis, but when you think about it, the difficulty is that the seller is going to keep all that cash. Because transactions are generally cash-free, debt-free, and you're just operating off a working capital target. And that's exactly how this LOI was structured. And I went back to the brothers and I said, there's a potential problem here. The seller has all this cash, for all the services, and you're left to provide the services after the seller leaves, and you don't have any cash to show for it. And I pointed out to them, that a conventional working capital peg would only compensate them for the delta or the change in the level of that deferred revenue. It wasn't going to compensate them for the real value of the work that they're going to do post-closing. So what happened was everything went dark for about 90 days. I thought I didn't get the deal. And what happened after 90 days, the brothers came back. They had a completely revised LOI. And basically told me, Bill, you weren't the cheapest guy on the block, but you were the only person who pointed out this issue. So that felt really good, and I felt like I saved the day for them. And now they're running a very successful company, but that could have been a big blow if they had overpaid and not taken that into account. So let's move to the next one, and this is the red flags example, and then I promise the rest of the time will be for everyone to ask questions because I love the Q&A. I love to be able to interact with you in that way. But remember, this is the first step in the process, is to kind of do this. Here it is, as I said, technically known as a two-finger flyby. We're trying to compare, in this case, just this year to last year. And what we see is, wow, massive increase in profit, right? The bottom line is showing $3 million this year and $0 last year. And, that's from an increase in gross profit, reduction in operating expenses, but it's all on static sales. Sales have remained at 10 million year over year. How could that be? All of a sudden that detective light goes on. What's going on here? There might be something more to us. And this is really what it's all about. is the detective work. So let's go to the next slide and see how their metrics look. So the metrics show, some extraordinary change, even unbelievable changes. I mean, whoa, we're going through the roof on gross profit margin. All of a sudden, we have a massive operating net income percentage to sales. But on the other hand, we have assets that are bloated to the ceiling. We have receivables increasing. We have inventory that's way, way up. So this is telling us something that, hey, there's something, there may be something wrong here. And so when we go to the next slide, we can see on that slide, ready? kind of behind the scenes, take a peek at what's really going on here. And something I emphasize to the MBA classes when I speak there is that this kind of gets back to accounting theory, to understand the interrelationships. But the bottom line, and I could go through examples and theory and everything, but the bottom line is the balance sheet ultimately determines your EBITDA. People don't really care or think about the balance sheet too much generally because, they're more worried about what they're going to get at closing and everything. But in the end, it determines EBITDA. So if assets are overstated, at some point in time, EBITDA was impacted, whether it was last year or years ago. And we'll walk through it in this example. So let's say we investigate here and kind of peel back the onion on this whole thing. So let's say, and I'll give an explanation of each of these items, and we'll see what the impact of it is. So the first one, let's say the reduction in receivables was because, the increase in receivables was because last year they were reserving an old account, like $1 million account, and it was collected this year. So we don't need the reserve anymore. Okay, so we reversed that, all right? So that went against our operating expenses. And then inventory. Let's say this is a manufacturing company that had been only capitalizing its materials and inventory, but now it started counting labor and overhead too. So it changed from an incorrect method to a correct method, and that added another $1 million, which wound up, remember, ending inventory bigger than beginning inventory. That $1 million goes straight to reduce your cost of sales. And then the third one, the payables. Okay, it went from $1 million to $0. What happened there? Well, it was in the drawer. Okay, manager hadn't approved. He was on vacation. Didn't know what to do, so we just kind of left him out. So those are all valid explanations, for these balance sheet changes. However, when you think about them in the context of 2020 results, none of them should have affected how we view this company. So the first one had to do with an old reserve. That $1 million really didn't have any reflection on 2020 operations. And similarly, the change in inventory method, if we had restated the beginning inventory in the same way we stated the ending inventory, there would have been zero effect. The beginning inventory would have been $1 million higher. And finally, those payables, well, they should have been in there. That should have been part of 2020 operations, and they weren't. So when you add up that $3 million, all of a sudden you've explained the entire increase in net income, and you've basically converted the 2020 statements into exactly what the 2019 statement showed. In other words, there was no change at all. So that's how significant these issues can be and how the balance sheet interplays with all of it. So let's turn to the next slide here, if we could. And then, as I said, I promise I'll open it up. Next slide after this, I think might be better, if we could advance that. Let me just say that I've worked with many searchers, and they engage me to verify what sellers tell them is correct, just as you would a home inspector. And they also want to have an advocate when issues arise. I was actually on the phone just a few minutes ago putting the finishing touches on a deal where there was questions about inventory, and we were able to negotiate basically a consignment arrangement for a certain portion of that inventory where we pay as we go. It's like an earnout rather than giving the seller the entire price at closing. And basically, the good news is that these engagements can start as low as $5,000 on small deals. We have developed a standard data book, that works for those types of engagements. Now, of course, we also do the 40, 50-page reports, but most of the time, those are going to be overkill. The SBA, for example, doesn't need an outside accounting firm's report. Most of them, though, will ask you, did you have a CPA look at the materials? And they may actually even want to speak with your CPA about the materials. So that's something, that you need to keep in mind. So let me open it up because, and I think we can actually take it down now, unless you want to flip through the remaining ones, Valentino, just quickly. I want to encourage everyone before opening it up to please link with me on LinkedIn. You'll see my name again at the end, but it's Bill Wiersema. You can also find me on the Miller Cooper website. Wiersema is W-I-E-R. It's on the last slide, Valentino. There he is. Bill Wiersema. There I am. Would love to link with you. What I do is disseminate things that are important as they come up. So, for example, the SBA finally came out with guidance on what to do if there's an outstanding Paycheck Protection Program loan on October 2nd. When it did, I put the whole thing up there, and sent it out. So people who were linked with me, knew about it right away because that's when I posted. Anytime there's a change in tax law, and, of course, I also post presentations, that I've done. So all of those things, I do in an effort to stay in front of folks and make sure you're getting some good information too, and that your thoughts are timely on all these topics. So I'd encourage all of you to please link with me. I welcome that and would love to have you and also to touch base too, talk about what you're doing and, particularly if you have deals, that you're looking at, love to look at them on a non-charge basis, under NDA. And give you my thoughts as well as, a potential program of procedures, outline where I think the diligence risks are. So there you are. So I'll shut up now. And I guess you can take that down, Valentino. I think we're done with that. And we can open it up.
Yeah, absolutely. As always, great presentation.
Thanks so much. Last time I didn't even do that. You remember? I had no slides.
Yeah, I know, right?
This time I decided the slides. Hope it didn't go too far on the slides, but last time it was just strictly free form, and I'm looking forward to that part of it now. So
yeah, of course. So, quick question. You did touch on due diligence with respect to company valuation. So how important is that, would you say, to get the right person to perform, the due diligence when you're getting your company evaluated?
Wow.
Or when coming up with a valuation for a
I'm
company.
so glad you asked that. I can spend a little while on that one. But yeah, let me put it this way. There's a lot of brilliant people out there like Valentino and Nancy. I deal with people from, every known, program university in the world, and they're very smart people, like you guys. But the thing is, they know that diligence is not something they'd want to engage in. It's something that it takes basically a career to get good at and to learn. I can tell you that auditing, as a profession, will keep people, around 5 years assisting on jobs before they can start running them themselves. And even then, there's 3 levels of review above them, looking over what they've done. So it's a skill that you have to invest the time, and you really have to enjoy doing it. So it's not something that you can master through an accounting course or an auditing course or even the CPA exam. It's something you have to learn by doing. The one thing that I remember, when I started with an accounting firm was how different it was from anything you learned in school. As tough as you may have heard the CPA exam is, it doesn't really prepare you for what you start doing. So that's the first thing to point out. The second thing is you can never take financial information you're being shown for granted because there's always something there. And I hear that a lot. People say, "Oh, well, what's the big deal here?" And the big deal is, you're committing and spending millions of dollars, on a deal where, unless that's pocket change for you, you're going to be concerned that you're getting what you're paying for. And as I said, it's going to take the specialized look that I touched on here, that I started to describe, to be able to identify what issues, what dangers lurk, but not just identify, but help you work through them, put in the suitable contractual protections, even price adjustments. Yes, those do occur as a result, like the one I just alluded to. There was a whole a whole doubtful receivable that we were able to chop out of a purchase price. So that goes on all the time. It's routine for me, and as I mentioned, it's a 6 to 8 figure savings. And when I compare that to what you're paying me, there's a little bit of a return. I'd say a massive return, on that, because I don't charge that much. Maybe I should, but I don't. So anyway, just kidding. Go ahead. Great question.
Yeah, I appreciate that. Another one. Could you get can you get a financing from the bank without getting a quality of earnings report?
Yeah, as I mentioned, I mean, like SBA, they usually, though, will ask, have you had a CPA look at it? They will ask that, and they may even want to talk to the CPA that you use. But generally, what they like to get is what I've been describing here as a data book, which isn't a report really, but it's a monthly adjusted EBITDA, that you can update on a rolling basis as new months occur. But it delineates all the adjustments, how they're computed, how you get to GAAP, which is generally accepted accounting principles. It's all rolled into a data book. It also contains the proof of cash and a payroll reconciliation, which are, very, very frequently demanded items. So it's kind of rolled. It's kind of a product that is suited for that type of lender. When you get to larger lenders or you get to larger investors, generally they probably would want the full report, which would kind of be the other end of the spectrum, which would have all the procedures, our letterhead, our report. That's the 40 to 50 page document. Generally, that's going to be overkill, though, for smaller deals. I'd say like 5 million valuation and below, it's going to be way overkill. Maybe even up to 10, you might get away with just a data book. So
okay, perfect. Okay, so you said earlier, you said something about increasing inventory to increase EBITDA. Like,
right.
What do you mean by that? Exactly. I've never heard that. Could you touch on that? What is that?
Yeah. And I can give you the
that.
opposite. Maybe the opposite is easier to understand. But, let's say you just started a business and you bought $100,000 worth of stuff during the year. And then all of a sudden year end is here. Let's say, you buy it late in the year and it's still there at the end of the year. So that's $100,000. The IRS says you're supposed to count that as inventory. You don't get to deduct that. You didn't sell any of that. That's an investment. But here's the thing. If you understate it and say you had zero inventory, all of a sudden you'd have 100,000 in deductions, 100,000 in expense. So yeah, so that's how it works. So and then conversely, if you have 100,000 inventory and you say you have 200,000 because you have to capitalize your labor to carry it into the building, and you're expensive, all of a sudden you've increased your EBITDA by an extra 100 that you really shouldn't have. So that's how it works. Yeah, it can be that simple. And again, it's just algebraic, and to me, it's become second nature. But I can tell you, I can promise you, when I first started in the profession, I had to think about it, but I don't anymore. Cost of sales equals beginning inventory plus purchases minus ending inventory. So, and underline minus ending inventory. But here's the problem: if you're a fraudster and you're doing that, what happens is, the next time you look at it, ending inventory becomes beginning inventory, and therefore, in order to get any benefit, you have to overstate it by even more. And if you overstated it by 100,000 last year and you want another 100,000 benefit, now you have to overstate it by 200,000 because it is cumulative. So it's like an addiction. It's like now you can't stop. It's like a Ponzi. It has to keep going, otherwise it doesn't work. So,
right. Okay, so just to go back real quick, just so the audience don't get lost, the formula. Just can you explain that to me as if I was a sixth grader? Just very slow. Not too in depth. We're not trying to do what you do, but I just want, very, basic level, they could understand it.
When I do MBA classes, I actually put a slide up there with the formula. I didn't know you guys are interested in that. I could have done that, but let me describe it this way. So, what is ending inventory? What does it equal? How does that come into being? Well, if you didn't have any beginning inventory, it would just equal what you bought during the year. And if you didn't sell anything, like that first example I gave, the 100,000 we paid for during the year, that equals ending inventory. But let's say you had beginning inventory. Well, you have to add that in too, right? I mean, you bought 100, you had 100 at the beginning of the year, now you have 200 at the end of the year. So the only other item is what did you sell? So If you didn't sell anything, you have 200 at the end of the year. But if you sold, 150, well, you have 50 left. So all you're doing is you're taking that equation, which is very intuitive. Everyone knows that equation, just rearranging it. So what you do is kind of you take that minus cost of goods and you move it to the other side if you know your algebra. So then what does cost of goods equal? Well, if you move the ending inventory where cost of goods used to be and subtract ending inventory, that's the formula. So in other words, cost of goods equals beginning inventory plus purchases minus ending inventory. All you're doing is you're changing places of cost of goods and ending inventory. I know maybe that's a little much, but let me just, as I said, if you walk through it, it makes a lot of sense. So basically, let's just take an example where it purchases. So you bought 100,000, you had zero beginning inventory, and your ending inventory was 100. So 0 plus 100 minus 100. If you sold everything, that equals ending inventory. That's 0.
Okay.
However, let's say that ending inventory is 200 instead. So you had beginning inventory is 0.
Mm-hmm.
You bought 100, and now you're saying ending inventory is 200. All right, where did that come from? Well, we're expensive. We carried the stuff in the building. Okay, so we're adding that in too. All of a sudden, if ending inventory is 200, well, you have a negative cost of goods sold of 100. Is that even possible? Well, it would happen, if you actually did that. So that's how it works. Yeah, you got to be careful. Inventory is the classic. And if you're interested in this, as I said, I just did a white paper. Anyone who writes to me, for a limited time, I'm just kidding. Anyone who writes to me, yeah, if you want to link with me and you want the white paper, I'll send it to you. But I wrote all about that problem because it's a problem. And a lot of times it's just an innocent problem. We don't know what our inventory is because our systems are bad and we have to count it once a year. And it leads to a lot of uncertainty. But other times it can be, oh my God, this is a problem. This is a way to do fraud. And I've seen it quite a bit in my career where, troubled companies all of a sudden start growing inventory to cover it up. So there you are. So
nice. So you said now another thing with relations to inventory. Mm-hmm. Why is there something wrong if it goes way up?
Oh, why is there something wrong? Yeah, well, again, if there's nothing, well, I guess there's a bunch of issues here. Number one, operationally, if you subscribe to, like the lean manufacturing philosophy or, anything like that, you want to keep inventory as low as you can because that minimizes the cost to carry it. And inventory is expensive to have around. Some people say, it's like if you can imagine like dollar bills on the shelf, because that's really what it is. That should be an investment that's returning for you. It should be turning over. It shouldn't just sit there. So from an operational standpoint, bloated inventories are bad. But when you think from an accounting standpoint, maybe you don't even have that inventory. Maybe it's not really there. Maybe it's that, the time it spent me to move the stuff in the building, that 100,000. Maybe that's what inventory is. So your ears kind of perk up, excuse me, as an accountant, that, there may be a problem here. There may be an overstatement going on. And it could be like in the example I gave, it could just be we changed methods on inventory and that resulted in a higher inventory, but that shouldn't be credited to this year's EBITDA.
Mm-hmm. Mm-hmm. Now, is it a red flag if you look at the, is it a red flag?
Excuse me. Go ahead.
Yeah, no worries. Is it a red flag when you're looking at the balance sheet and you see the current assets, historically is decreasing, but the current liabilities continue to rise? They're increasing. Does that mean the company's going under necessarily, or are there like other factors?
It could, and there's some formulas and metrics. There's one called the Altman Z-score, which came out a long time ago, which is based on an empirical study where you enter certain financial variables and it'll give you kind of a bankruptcy predictor. Is this company going under? But to me, if liabilities are growing, it's not a good thing. It usually means people are stretching their payables, that type of thing. Now, maybe they did renegotiate, with vendors and get 90-day terms. Well, that's one thing. But If they're just growing because we don't have the cash to pay them, that's a big problem. So you have to be very careful of that sort of thing. And I'm sorry, just running back to inventory though. I recently did a deal where, I was just blown away. The client wanted me to compute, basically the conversion cycle, which basically takes into account how many days receivables and inventory you have minus payables. How long does it take from, you're buying the inventory to getting the collection, from selling it. And this company I was looking at was 4 years.
Wow.
And it was because they had all these channels, they had these reps that they consigned inventory to, and they frankly didn't have a lot of controls. And then not only that, they were messing around with their overhead and capitalizing too much. They had a couple of years worth of warehousing, expense, facility costs capitalizing the inventory, added to inventory. So it was partly nonsense and it was partly bad operations. So always something to be concerned about.
Mm-hmm. Now, me, I'm in healthcare. I'm looking at, medical practices and stuff like that, clinics,
Sure.
which aren't necessarily asset heavy when it comes to
Right.
those. And they're more so, specialty practices,
Right.
if you will. So now
Sure.
how difficult would it be, when getting financing from banks when a business is not asset heavy? Is it solely reliant on the cash flow? And if so, what DSCR would make the lending institution or bank comfortable? I know it's like, hey, 1.5 DSCR, 1.75.
Right.
But if we're there, if you're at 1.75, and that's what the bank's looking for, are they really going to lend to you being that tight? And if you're not asset heavy?
Well, here's the thing, and this is one of the beauties of, like the SBA program. The bad side is that, oh my God, you're going to tie up all your assets. They're going to want to lien your house if there's something available there. They're going to attach everything. So that's the bad news. But the good news is that you can get a 10-year unsecured, term from them and not even have covenants other than those imposed by the bank, that is between you and the SBA. And usually that would be limited to maybe, tangible net worth or that type of covenant. So there is financing available, for you to use under those circumstances. But generally, the difficulty is that, now medical receivables, I wouldn't say are as problematic as, say, progress billings for a construction contractor. Those are, even more, those are more problematic because those are intended to fund the construction, and therefore banks don't want to lend on those. Although there are some specialty banks that will, but medical, I'd say the issue is more, regarding realization and collectability. I can tell you in my diligence experience, there have been a number of shockers, with medical practices, and I'll give you a couple examples here. One is the variance in realization rates, by payer source, and how crazy that can become. I've seen where people are getting 20% of what they're billing from some sources. Another is changing the payment term. So I had a situation where the payer source, this wasn't immediately or readily apparent, but when digging into it, a payer source had changed its method of reimbursing. Rather than a per service, it was a per diem is what they changed it to. And it just blew out like 2/3 of the EBITDA of the company, when you projected it forward. So have to be real careful, with those aspects. But you can find some specialty lenders, for medical. I actually have clients, for example, that will lend on medical equipment. For example, they specialize in that, so they'll handle that part for you.
Oh, wow, really?
Yeah, but
wouldn't the UCC1 be included in those things? Are they able to lend on those assets if the bank ties
yeah,
up?
well, if it's outside of if it's like it was acquired later or it's carved out of the agreement, yeah, you'd be able to do it. Yeah, I have clients doing it all the time. Yeah, multiple loans out there, sure. Sure.
What about could you pledge accounts receivables to investors, or will the banks tie those up to?
Oh yeah, it depends.
Yeah,
It depends.
right,
And obviously, you can't do that after you bring in the bank. You have
Hey.
to. Yeah, that has to be part of. Yeah, the understanding up front. Yeah.
Okay.
Yeah.
Right. So basically, it's wiser to bring the investor on before the bank. No,
Yeah, there you go. Yeah, there you go. No, that's a good one. Sure, and it
But
is
look
especially
though, so
especially
yes,
subordinated. I mean, and
right,
another
right.
piece of good news. I know a lot of times, these days there may be seller notes involved, or contingencies or earnouts. One piece of good news is that generally the seller note, to the degree it's subordinate to the bank, which the bank is going to require, will count as equity. So when
Hmm.
you're doing your debt to equity ratio, that's
Hmm.
equity, even though you didn't
Right.
put it in, the seller left it in. You get to take credit for that. So that's a bit of
Basically,
good
so if the
news.
seller agrees to finance 30%, the bank count that as equity.
Exactly.
Nice,
Exactly. So that's going to
nice.
help. That's going to help
Right.
you. Right.
Right.
So,
Now you mentioned also that I know Valentino has a few questions. I'm about to, I'm almost finished with mine. But you
sure.
mentioned some. Well, I'm not sure if you mentioned it, but uh, how often do you see deals where the buyer keeps the aged receivables and the aged payables?
Oh, you mean the seller keeps them?
No, no, I'm sorry. The buyer, as the buyer, could we negotiate the receivables? Basically, what they've already performed a service for, and they're waiting on that, to get paid on those.
Oh,
Are
yeah. No, no.
are
I mean,
we as buyers are we able to negotiate to keep a portion of that or all of
oh,
that?
yeah. No, no. I mean, here, I mean, I know in medical practices like you're describing, generally they're going to be, generally there will be terms where the seller may keep, that stuff, and you as a buyer won't get it. But in the larger deal world, when you look at how companies are valued, as an EBITDA multiple, that multiple is supposed to cover all the operating assets necessary to run the business. So that it will be your receivables, your inventory, your equipment, not real estate, but equipment. And then also, though, against that, accounts payable, trade payables. So it's all of those things are supposed to come with a multiple. Now, if a seller doesn't want to give you those, then they have to reduce the price. There has to be
Wait,
an
okay.
adjustment. So yeah, but no, but I've seen what you're describing. Of course, I see that all the time in medical deals, because a lot of times what's left as receivables is going to be, it's not easy to collect. It's kind of,
Hmm.
it's tough. What's left on the books. So I'm sure you can have it if you really want it.
All right, my
You
final
can
question
negotiate it.
for
Sure,
tonight.
sure, sure.
Would you recommend SBA for someone who's trying to make multiple acquisitions?
And that's tough. Yeah, I know that and I think it was you who told me about, that you'd encountered like a 5 million limit on that.
Yeah.
Yeah. So that's a tough one. Yeah, that's really tough. And so if you're purely someone looking for, not a searcher, what's the word I'm looking for?
Owner operator model.
Yeah, yeah, yeah. If you're purely looking for that to run a business for the next few years, grow it and sell it, SBA is probably going to be your way to go.
Mhm.
But you want to, if you're a serial entrepreneur, and you
Right.
want to do it all at once, you're going to have investors, everything else. SBA isn't going to work for that, because
Right.
they're going to want guarantees from your investors too, and they're not going to, they're not going to
Perfect.
do that. Yeah.
Didn't think so. Didn't think so. Hey, Valentino, let's go, man. Step in. I don't want to steal the night from you. I got a lot more questions.
Yeah, I'm here. I'm here. Hey, Bill, I appreciate that. The presentation, great information. You've proven yourself
Thanks.
over and over. You're an expert in your field, and people can see it. So I got a
Thank
couple
you.
questions for you.
Hmm.
Let me see. One dude said, "How well do clawbacks work? Are they standard, and how effective are they to enforce?"
Well, here's the issue. The issue is if you're going to do a clawback, because there's an uncertainty, it's really not going to advance you with the lender. Normally the reason you're doing, either a clawback or an earnout is because there's uncertainty around valuation. And usually that arises because the seller believes that the future holds a lot better picture for the company than the past. So there is going to be a certain leap of faith involved, a certain level of uncertainty. So normally that defaults to an earnout because that way the buyer pays only when the achievement is demonstrated as opposed to beforehand. So the buyer doesn't need to fund that. A clawback, on the other hand, means that the buyer has to get the funds, to pay now. And then if it doesn't happen, get the money back, hopefully. So as a practical matter, I don't see them very often. Now, I just saw one a couple days ago Little different scenario, though. The clawback just related to an asset, that was being purchased, and the seller had to meet